Hello, sir. Sir, good afternoon, sir. I am
Good
audible, sir.
afternoon, sir. Yes, sir. Audible. Oh, vote of thanks, Sanani.
Yes, sir. I'm ready, sir.
Report, and then you can write the report as well.
Yes, sir. Yes, sure, sir.
Thank you.
Ganapati,
Thank
sir.
you. Yes, sir. Audible. Good afternoon, sir. This is
Hello, sir.
Ganapati.
Good afternoon to you.
Yes, sir.
Namaskar. Vanakkam.
Vanakkam, sir. Sir, I have shared that yesterday's day 3
Yes,
answer,
sir.
which I.
Actually, it's not been cumulated.
Okay.
The scores are only.
Cumulative.
I'll talk to you later.
Okay, fine, sir.
Maybe
Fine,
what
fine.
we'll do is that you may later on you may share the scores over the Zoom, the WhatsApp group with the participants.
Definitely, sir. Sure, sir.
Thank you. Thank you.
Thank you.
Thank you.
We can wait for
Yeah,
another
yeah,
2
sure,
to 3
sir.
minutes, sir.
Sure,
Yeah.
sir, sure.
Thank you. Thank you. Ma'am, Rajalakshmi, ma'am.
Can you hear me?
Yes, ma'am. Yes, ma'am.
Can we start?
Yes, ma'am. We can. We can.
Okay.
Please proceed, ma'am.
Good afternoon, sir. Okay. A very happy and wonderful afternoon to our esteemed facilitator, beloved principal, respected director, faculty members, researchers, colleagues, and friends who have gathered here today. On behalf of our institution, SA College of Arts and Science, I take immense pleasure in welcoming you all to day 4 of the 7-day online faculty development program on cognitive analysis in financial services, organized by Internal Quality Assurance Cell, IQAC, in association with the School of Commerce and Management, SA College of Arts and Science. I would like to share here a Buddhist quote. I quote, "A jug fills drop by drop," I unquote. Similar to the saying, we are fortunate that we are getting our mind vessels filled with floods of knowledge each day, and I congratulate all our receptive participants who were consistent and enthusiastic throughout the past 3 sessions, and thanks to our honorable resource person for all the extraordinary sessions. Thank you, sir. And without much ado, I request our most respected facilitator, Mr. Ravinder Singh Chawla, founder and managing partner, RSC Skill Building and Consulting Solutions LLP, to take over the session and address the audience on the topic Investment Management Debt Markets. Thank you, sir. Over to you.
Thank you so much, madam. Good afternoon to you. Good afternoon, everyone. Namaskar, Vanakkam. It's indeed a pleasure being here with you all once again on day 4 of the online faculty development program. Today, we'll be learning about, again, a very important thing, which is debt markets. So let me connect the presentation. All right, so I hope the screen would be visible to you. There is some error which has happened in compiling these scores for the quiz. So kindly allow me to we shall be sharing these scores with you later. Maybe the same will be the scores of top participants with top scores cumulatively shall be shared by sir over the Google group or the WhatsApp group. I beg your pardon. Okay, so apologies for this particular delay. Uh, uh, I wanted to submit one thing that still there are a lot of participants who've been submitting the answers more than once. Now it is quite possible that they may have been trying to figure out the answer, the correct answer, and that is why they would have been submitting the quiz again. So from today onwards, the quiz would also carry the correct answers. So after you've submitted it, let's say a particular question has been answered, incorrectly. So you would be also able to make out as to what would have been the correct answer option. So probably then there would be no need to resubmit the answers again, because it adds to our work. I mean, it adds to unnecessary work in terms of compiling these scores, and I'm sure you would all appreciate it, because knowing you all, I'm sure you would have been administering multiple quizzes every day. So who would understand it better than you all? Okay? So you'd be able to make out the answer. But I must admire, the enthusiastic participation that you have all been showing, and thank you so much for that. Really appreciate it. Now, when we talk about the debt markets, can somebody share in the chat box as to why is debt market such an important concept? Why are we learning about it? Yes, please. Why are we learning about the debt markets? Why do you think it's an important concept? Any answers, please? Okay, by the way, first of all, do we know what debt market is? What do we mean by debt? So DEBT, when we pronounce it, the B is silent. So it's about the debt. It's pronounced as debt. I mean, something like DET, you could say, because B is silent there. Okay? So we can increase the allocation across one more asset class, right, Midita madam? Yes, Narpada madam, debt markets do offer some additional tax benefits. Yes. So we shall learn about the tax benefits in this session, probably the last session, when we shall be learning about mutual funds. So we have 2 days. So we shall be learning about both the tax aspects related to equity as well as debt. So that is how I've planned it. Instead of learning everything about equity in one go itself, it may become too much of content, so to say. So the good thing is, Principal Madam and Director Sir, they have approved the course content in such a manner that it covers everything, right? So we shall definitely be talking about the tax aspects also in the last 2 days, next Tuesday and Wednesday. All right. Sorry. So debt, as the name says, is loan, right? So instead of you investing, in the company where there is a risk whether the company will do well or not, right? You are going to be participating in the company's performance. So while definitely the returns have been far higher in case of equity, debt gives you this particular security that your principal may not be at risk, right? Though we shall learn about the risk aspects as well, but primarily speaking, the fixed income instrument, it's also referred to as the fixed income instrument. You do get regular interest payment, right? So, and thereafter you get the principal back. So, remember we spoke about the asset allocation concept, that we should not put all eggs in one basket, right? So while let's say somebody's allocation to equity may have been 80% or 70% or 60%, whatever, the balance aspect could be in debt also, other than maybe other asset classes, right? So debt definitely gives an alternative perspective to your portfolio, and you are able to reduce the total risk. So let's go through what is it that we shall be learning about today. So we shall be learning about the need for debt market, right? What are the debt, different kinds of debt market securities? What is the relationship between interest and the bond prices? And this probably is the most important concept which is there. This definitely is a very, very important concept. And believe you me, while people, a lot of people know about equities, unfortunately, not many people know about the debt markets, right? But is it important for our investment approach? Definitely, it's very, very important, right? So hopefully, by the end of this particular program, on Wednesday, you should have been able to learn quite a few things about the entire investment approach. And then we should also learn about risks in debt markets and how to be able to manage those risks. This is in continuum actually. Yesterday we learned about equity markets, but then there are a lot of things in equity markets, which we should also be learning in these sessions on mutual funds, right? And that would really help you to be able to get comprehensive knowledge. Same with today's session as well. So we shall be learning about quite a few things in the next session on mutual funds, right? Because the debt products, the debt mutual fund schemes are again very, very important. All right. So just to set the tone, let me ask a few questions to you. So a company needs short-term loan for a few months, right? Any business, anyone who's in business may require some short-term loans, right? It could be a working capital loan. It could be for, let's say, to take care of some increase in capacity, whatever, right? A particular company needs a loan for a short term, right? What should it do? Whom can it approach? What can the company do? Who should it approach? Yeah. What can the company do, and what should, whom should it approach for loan? Banks. Yes, it would approach banks, right? Who else can it approach? Yes, absolutely, Priya madam. Perfectly right. Fantastic answer. Great, super. Financial institutions, right? What else? Okay, now tell me one thing. So the banks would be financing, right? Now, where would the banks borrow money from? Banks would also need money, right? Of course, we know that RBI is bankers' bank. So RBI can take money from bank. RBI banks can take money from RBI. But then they may also need more money, and they may, yes, Narmada madam, investors, right? So we can also, the banks would need money from the financial institutions, And financial institutions again would need money from different other entities, including retail investors. Okay, so obviously this is a business opportunity. See, because somebody is wanting to take loan and somebody is willing to invest, right? So as we know, the market, what we call as market, so market, anything which we call as market is actually a collection of buyers and sellers, right? We cannot have market without buyers and sellers. Why do colleges exist? Because just like there are, so at one end there are knowledge seekers, the students who are there, and at the other end you have people who are willing to impart knowledge, you all, the respected teachers, right, faculty members. Now you cannot have markets existing without both the entities there, right? Similarly, when it comes to the money market or the debt market, so to say, you have borrowers also, you have lenders also. Right? Similarly, a bank has money available and it wants to lend to others. Right? See, what are banks? So banks are actually those entities. So let me explain it to you. See, the main business of bank is maturity transformation. Maturity transformation. Now, what does maturity transformation mean? So the banks would borrow money from you, me, businesses, etc., etc. How? So they will get current account, savings account, right? They will get time deposits, for example, what we call as fixed deposits, right? So they will get this money from people and then they will borrow this money. Now let's assume that the average interest rate which they are paying on this is 5%, just for example, right? Now what they will do is that they will lend this money to people who require money. It could be businesses, it could be corporates, it could be small self-employed people, it would be people who require car loan, auto loan, personal loan, etc., etc. Right? So they would lend this money, let's say, at average rate of 9%, for example. Okay. Now this difference between what they are lending the money at versus what they are borrowing the money at, this is called as, for banks, this is called as net interest margin, right? So they will lend money for long term, right? They will lend it for medium term and long term, and they are borrowing money for on an average for short term, right? So this is maturity transformation, and they are gaining out of this. So that's the interest margin that they are earning. That is how banks exist, and that is what their main business is. All right. Similarly, a mutual fund company has money available and it wants to lend, right? Now, government also wants to borrow money because the government has to run multiple schemes, right? Every government would be running a lot of schemes for the welfare of the poor, correct? It would also want to build infrastructure. Now, the government would be borrowing money, right? Which means there are people who require money. There are people who are willing to lend money. And that is what makes the debt market, right? So the government would also be borrowing money from mutual funds, from banks, from insurance companies, from retail investors as well now, right? So let's look at debt as an asset class. So in the first session, we learned about that we have equity as an asset class, we have debt as an asset class, we have real estate as an asset class, we have gold as an asset class, right? So we have different asset classes which are there. So debt is a very important asset class. Now, see, when you are giving money to someone, when you are lending money to someone, right? What you are doing is that you are delaying your ability to consume that money, right? Suppose you have money available with you, you can consume it, you can buy different stuff out of it, right? But you have decided to postpone your consumption, right? Or you have decided to not consume, things which you wanted to consume by passing on that money to someone else. Now, because you are delaying your consumption, you would want to get remunerated for that, right? So, this interest is your remuneration for delaying this consumption, right? For sacrificing the consumption, right? So this is the reward for you. The interest is actually reward for you, right? Okay. Now again, why would people want to invest in debt class? Because as compared to equity, right? Again, as compared to real estate also, there may not be any risk. There may be limited risk to the loss of capital, right? For example, let's say if you're doing a fixed deposit with a bank or with a very reputed company, right? Obviously you have this assurance that your money will not, the principal will not be at loss, right? And you may be getting your interest also time, right? Similarly, with government, when you lend money to the government, then there is no risk of principal at all. Okay, so this is called as, from a technical perspective, this is called as credit risk. So one of the biggest risks, in fact, actually the biggest risk in the debt market is credit risk. Credit risk means when you are lending money to someone, whether that person will return your principal or not, right? Actually, it is principal plus interest, but at least someone can forego interest, right? I mean, in a worst to worst situation, but you wouldn't want to forego your principal, isn't it? Right? So when you lend to private sector, obviously there could be credit risk, but when you lend to the government, right, then there is no credit risk which is there, right? Because if the government cannot honor its obligations, then practically speaking, nothing will work, right? So in case of government securities or government bonds or whenever treasury bills, which are instruments whereby the government will be borrowing money from you, there is no credit risk, right? But when you lend to other people, they may they may they may not be able to honor their commitment. That risk is there, right? For example, Vijay Malaya, we all know he owes a lot of money to the banks, right? We all know what happened with Nirav Modi. We all know what happened with DHFL, Ireland Affairs, right? It had also happened with Yes Bank, right? We all know about it. So there is credit risk which is there in debt, but not with the government securities or treasury bills or whenever anything government is borrowing. So what is a bond? See, bond is a promise. Simply speaking, it is a promise. I am sure you would have heard a lot of people say that you can get a bond signed from me that I will honor this promise. Right? I am sure in the normal conversation also, many times when two friends are talking, right? They may tell each other, you don't believe me? You better get a bond signed from me. Right? So bond is like a sworn promise which is being made that I will definitely honor this commitment of mine. Right? The bond, as the name says, bond, it's a promise which is there. So that is how the word bond has come. So when a borrower, right, any borrower is issuing a bond, right, for borrowing money, it is telling the lender that I am making a promise to you that I will honor this promise. Say, what is a rupee? The currency note, right? It's actually a paper note, right? But it's a promise which is being made by RBI. It's a legal tender which is being made by RBI that I promise to pay the bearer the sum of so many rupees. Right? That's also a promise which is there. Right? Yeah. So it's a promissory note. Perfectly right, Madam. Yeah. All right. Okay. So who are the players in the debt markets? Right? So banks, financial institutions. Who are the financial institutions? So there are big financial institutions, right? Although LIC is actually an insurance company, but it's a big financial institution, right? LIC also lends to the government. Many times, whenever the government needs money, it takes it from LIC. LIC also, it's a big financial institution, right? Plus, you also have NABARD. I'm sure you would have heard of the term National Bank for Agriculture and Rural Development, NABARD, right? You have IDBI, right? So these are all big financial institutions. There are others also, right? There is so they are the ones who are big financial institutions. You have insurance companies today. They also, because they collect money from from people, right? And in case of the traditional insurance products, the non-unit link products, the non-market link products, right? They are, as per IRDA's norm, they are supposed to invest a certain percentage in government securities, right? So around 80% is invested in government securities. So insurance companies play a very important role. Mutual funds play a very important role. So mutual funds have debt schemes, right? What we are learning about now about debt products. Mutual funds have debt schemes. So they would also be lending money to the government, right? Government as well as the corporates. Okay? Corporates also are there. So corporates also would be, lending money. If let's say a particular company has money on its cash flow, it does not need it. It would invest in debt schemes. Right? It would need money also. It would borrow money also. So it's not that all these players would only lend money, they may also borrow money. Right? There would be primary dealers, just like brokers are there. There are primary dealers in the debt market also. Right? And now the government has also allowed retail investors, people like me and you, to also be able to participate in auctions of government securities and treasury bills. Right? Earlier, the minimum amount that it required was huge, more than 2 lakhs, 5 lakhs. But now you can also invest 10,000 rupees directly. You can give money directly to the government, right? And as we discussed, there is no credit risk there when you give money to the government, right? So these players are there in the market, in the debt. Now, just for a recap, let us again revisit various asset classes that we had learned about in the first session. Okay, so in the debt market, what kind of schemes do you have? So A, you have fixed return instruments. Those instruments which offer guaranteed returns. So you have savings bank account, you have fixed deposits, you have recurring deposits, right? You know how much of return you are going to get. Absolutely fixed, right? There are also small saving schemes with post offices and banks, right? You have public provident fund, you have national savings certificates, you have Kisan Vikas Path, you have Sukanya Samriddhi Yojana for the girl child, right? Anyone with a girl child of up to 10 years can invest in this Sukanya Samriddhi Yojana. Right? So there are various kinds of schemes which are. Again, when we talk about the debt market, so this is also part of the debt market, right? But what we are going to learn about is in terms of the money markets, the bonds, corporate bonds, and the government bonds, also known as the government securities, right? Also referred to as the gilt securities, gilt-edged securities. So there's no difference between government bonds, government securities, and gilt securities, right? It's different names for the same term. Equity is another asset class. So today we shall be learning about these three things. Equity, we have already learned about. Hybrid is a combination of equity and debt that we shall learn about on Tuesday when we shall learn about mutual funds. Okay? So mutual funds have schemes wherein your asset allocation is built in, right? You have products which offer you both the benefits, equity as well as debt. It's like you having a pizza with two flavors, right? Or you having an ice cream with two different flavors. Other bonds, again, which we shall be learning about today, is gold bonds. Right? In the first session, somebody was mentioning about jewelry. And if you recall, I was suggesting that no, jewelry is not the right way of investing in gold. Sovereign gold bond is a very good way for investing in gold, right? So we shall learn about sovereign gold bond as well today. Real estate, we all know, right? And then there are alternative investments which are there, right? There are hedge funds, there are real estate investment trust, infrastructure investment trusts, etc., etc. Okay? So that is something which we should not be learning about. Maybe we can talk about REIT in the mutual funds session that we shall have. All right? Okay. So this is just to give you a snapshot. These are the current rates of interest for the fixed income schemes of post offices and other small saving instruments, right? So senior citizen saving scheme is for those people who retire, right? People after the age of 55, somebody who's taken a VRS or somebody who's attained superannuation, they can put their money in senior citizen saving scheme. Interest rate is 7.4% per annum. Right? Public provident fund, we know it's a 16-year scheme where you can get 7.1% these days, right? Kisan Vikas Patra is 6.9, and Sukanya Samriddhi scheme, which I was talking about, that gives a return of 7.6%. By the way, this 7.6% is tax free. There are no tax payable. If let's say somebody were to put money, for 18 odd years, and this is tax free, right? All right, PPF is also tax free. Right? Okay, so let's learn about Indian money market. Right? Now, Indian money market, as you know, comprises of both organized sector as well as the unorganized sector. I am sure you all would be knowing, and I'm sure in Tamil Nadu also and other parts of the country also, there are a lot of people from the unorganized sector who lend money to people. So they may be lending money to villagers, they will be lending money to farmers, they will be lending money to small traders, right? So different people are called by different names. In Karnataka, they are known as Shettis, right? So Shettis would lend money to people. In the north side, they are called as Chaudhries, right? In Gujarat, they are referred to as Patels, right? I don't know what they are referred to in Tamil Nadu. Maybe you can put write in the chat box. So these are the people who belong to the unorganized sector. In the movies also, you would have seen a lot of Hindi movies. They've shown that. I'm sure they would have shown that in Tamil movies also. So these are those people who charge exorbitant rate of interest for the money that they have lent. And many times, as they would show in movies, so they would when the farmer is not able to pay back the loan, they would ask the farmer to hand over his farm, the land to them, right? So that's the unorganized sector. But but thankfully, gradually the unorganized sector is shrinking, and it's all becoming the organized sector. So in the organized sector, you have RBI as the regulator, right? So the money market is regulated by the RBI, right? Whatever auctions, whenever government needs money, whatever auctions are done, it is done by RBI, Reserve Bank of India, right? So Reserve Bank of India is at the hub of the organized sector, right? And then you have scheduled commercial banks and non-scheduled banks. And within the scheduled banks, you have both foreign banks and Indian banks as well, right? So this is how, broadly speaking, the money market is like. Let's now talk about the various kind of debt instruments which are there. Okay, so to make it simple to understand, let us classify it in two terms. One is where the money is lent for 1 year, up to 1 year, right? So in these instruments, the money is not lent, right, beyond 1 year, right? And the other one is debt instruments where the money is lent for more than 1 year. Right? Now, money could be lent for short term also here, right? But in these instruments, money is lent and borrowed. The term is maximum 1 year. So what we'll be talking about here, the maximum term is 1 year, right? Here, yes, they can also be here, right? But these ones, the ones we will talk about here, cannot be here. I hope you're getting it, right? So this is only up to 1 year. This is more than 1 year, but yes, they can also lend for shorter term also. But more often than not, what we'll talk about here is primarily more than 1 year. Right? So let's check out. So the first one is call money. Right? Now this call money is between the banks. Okay. So let's say this is, sorry. So this is bank A, right? This is bank A, this is bank B. Okay. Now bank A needs money for 1 day or for 5-6 days. Let's say a week's time. Right? It needs money for a very short period. Okay. So it would borrow from this bank. Okay. And after that period, along with interest, it will give the money back to this bank. Right? Generally, it is for 1 day, overnight. Right? Let's say, for example, a bank needs money on a Saturday evening or a Friday evening. So it will need money. It will take money and then it will return it back on Monday. But it could be for 3, 4, 5, 6 days also. Right? The other one is what is called as the collateralized borrowing and lending obligations. Right? Collateralized borrowing and lending operation. Now, what is it? Say, for all practical purposes, here also the purpose is the same. Right? But this is call money is only between or amongst the banks. Right? So one bank needs money, the other bank will give it, that's call money. But what if one corporate needs money, right? And it requires it from a bank or for some other financial institution, let's say a mutual fund, for a period of, let's say, 1 day or 2, 3 days, 4 days, right? Then in that case, a bank and a non-banking institution, they cannot get into a call money transaction, right? So in a CBLO, collateralized, here a non-bank, it could be an NBFC, let's say Muthoot Finance, right? Muthoot Finance is an NBFC. Now let's say Muthoot Finance needs money overnight. So it will go to Indian Bank, right? So Muthoot Finance goes to Indian Bank, right? So this transaction would be between a bank and a non-bank. So this would be called as, so the instrument that will be exchanging, money against, be collateralized borrowing and lending operation. Now, what is collateral? Collateral is security, right? Anything which you leave as a collateral. So when you go to Muthoot Finance, what's the collateral there? Gold, right? It could be a jewelry, it could be a bullion, whatever. So the collateral is the gold. Here the collateral is the government securities, right? Or any other security which is acceptable to the other institution. Normally it is government securities, right? So this is CBL. I hope it stands clarified. The other one instrument is treasury bills. Now the treasury bills could be 90 days, 180 days, or 364 days, 365 days, right? It could be 3 months, 6 months, 1 year. Treasury bills. So treasury bills, again, as the name suggests, it's a government security instrument, right? But treasury bills, the period is only up to 1 year. So as we discussed here, period is only up to 1 year. Whatever borrowing, lending happens is for a period of up to 1 year on. Right? Then you have fixed deposits. Now fixed deposits will come here also, but here we are talking about fixed deposits only up to 1 year. Right? Now these fixed deposits could be taken by banks. So when you give money to the bank, you are actually lending money to the bank, isn't it? The bank is a borrower. right? You are the lender. When you open a fixed deposit, you are the lender. You are the lender, right? Similarly, a company may borrow money from fixed deposit. So let's say TVS Motors, right? TVS Motors may require money. So they may, come with a fixed deposit scheme, right? Period could be 1 year. Okay. Similarly, another instrument which banks have is called as certificate of deposits. So this is also like fixed deposit only, where the money is borrowed by the bank for a certain period. Here, the transactions are generally between a corporate and the bank. So the bank may require money, right? And the bank will issue certificate of deposits to the corporate. The other ones is commercial papers. So commercial papers are lending which is done by the, borrowing which is done by the corporate, right? So let's say Reliance requires money. Reliance Industries requires money. Example, right? So they may issue commercial papers and people would lend money to Reliance. It could be any corporate. I'm just giving an example, right? So these are commercial papers. So these are all up to 1 year period. Okay. More than 1 year, what could be there? FD and company deposits. We all know that, right? Again, companies would also issue corporate securities, corporate bonds, and these would be for a longer term, beyond 1 year, right? It could be as long as 20, 30 years also, right? Similarly, they may also borrow money against debentures. Now, debentures could be of two types. One could be convertible debentures, where the borrower says that after a particular period, whatever money I have borrowed from you, it will be converted into equity shares, right? So convertible debentures mean that it would get converted into equity after a certain period. The other one could be non-convertible debentures, right? So we should all learn about it. Non-convertible debentures are those debentures where the lender is only promising to pay a certain interest rate. There is no conversion into equity, right? So the lender says, I will give you interest, and after, the borrower says that I will keep paying you interest, and at the end of the period, I will give the money which you have lent to me, I'll give it back. Right? So that's the non-convertible. Difference between bonds and debenture, madam, we'll learn about it. So we shall learn about it in detail. This is just a trailer, just to give you an idea about what is it that we should be learning about. Bonds. Again, here the government is borrowing money, and here all we are talking about is more than 1 year, right? It's a promise, as we discussed, right? The states would also need money. Different states will need money. Tamil Nadu will also need money. Kerala will also need money. Punjab will also need money. Mumbai, Maharashtra will also need money, right? So they will also borrow money. They will also borrow money through RBI. All right. Now, see what debt securities do is that they give you an alternate security to your portfolio. That, let's say the equity markets are going on. Let me give an example to you. Let's say you have put, just for example, you have put 80% money in equity and 20% allocation is to debt, right? Now let's talk about two situations. In situation A, equity gives you total return of let's say 20% in a year, right? That gives you return of, let's say, 7%, right? Now, suppose you had 1 lakh rupees, you've invested 1 lakh rupees, 80,000 is being invested in equity, 20,000 is being invested in debt, correct? Now, with equity giving you 20% returns, right? 80% of your money is in equity, right? You've got 20% return, which means your portfolio would have been up by 16%, right? 80% of 20%, 80% of 20% is 16%, right? Similarly, 20% of your portfolio has given you 7%, right? Which means your portfolio would be up by 1.4%, which is 20% of 7%, right? Which means the total return you would have got is 17.4%. Correct? Now let's look at situation 2. Let's assume, just for the sake of understanding, that now your equity market in that year gives you only 2% return. Only 2% return, right? So your returns from equity markets, because 80% money is kept there, right? So 80% of 2% is 1.6. So practically your portfolio has given you only 1.6% return, the equity component, right? But since you had 20% portfolio also in debt, which has given you a 7% return, right? So 7% return, 20% of your portfolio giving 7% return, you've got 1.4% return, right? So the total return is 3%. Right? Now just imagine, had you put all your money in debt, equity, your total return would have been only 2%, right? But because you had also 20% of your investment in debt, now it's acted as a cushion, right? It's acted as a cushion, and your return is 3%. So it offers you a cushion to protect you against, the high volatility in the equity. So that is what the risk allocation approach does. It reduces the total risk, right? So what does the return comprise of in debt market? So it comprises of interest income, right? So let's say you have lent 1 lakh rupees. Let's say 10,000 rupees you have lent, right, to someone, and this person says that you will get 7% interest on an yearly basis, right? Then practically speaking, suppose the term is 3 years, correct? Let's say you've lent this money in 2021. Then after 1 year, 2022, you get 7% interest, right? 7% interest on 10,000 rupees is 700 rupees. So you get 700 rupees. Next year again, you get 700 rupees, right? Right now I'm only assuming simple interest for the sake of simplicity, right? So you are getting 7% return, and 2023 you get 7%, and 2024 at the time of maturity, because you had lent money for 3 years, right? How much money will you get? That's a question for you. At the end of year number 3, right? How much money will you get? $12,800. Why 12,800? I'm talking about only after year 3. Just after year 3. At the end of year 3. So I'm only assuming simple interest here. How much will you get at the end of year 3? First year you got 700 interest. Second year you got 700 interest. Next year, at the end of year 3, you will get 700 as interest. 700 as interest, plus you will get your 10,000 back, which is your principal component. So you will get 10,700, right? So this is how it works. Okay. Actually, you were talking about cumulative one. Okay, madam. Yeah, I understand that. Fine. Yeah. Okay, but so I was not able to understand. All right. Yeah, cumulatively you got that money. You're right. But remember this thing, why we are discussing it, because this will come handy when we will understand about discounting. So just to set the tone for what we shall be learning about today. See, in terms of investments, the period when you invest money, which is today, if you are putting money today, this is called as zero period. This is zero period, right? After 1 year, it will be period 1. After 1 year, period 1. After 2 years, period 2. And after 3 years, it will be period 3. Just keep in mind. So we will discuss it later on. Okay. Today, when you are investing, this is period 0. Right? Okay. Plus, there could be a probability of capital gains as well. In the bonds, there could be a probability of capital gains as well. We should learn about how is it possible, right? So there is a chance of capital gain as well. We should learn about it later. And so this capital appreciation happens when the interest rates are falling. Okay, we shall learn about it. I don't want to talk about it right now, but we shall do that after some time. Okay. All right. So we shall learn about it in detail in the mutual fund section, right? But what are the various kinds of schemes where you can invest money in a debt mutual fund, right? Are these one. Now, these have different, the scheme is suitable for a certain period, which means, so let's say you want to go to, you want to travel to Coimbatore from Chennai. Right? If you want to travel to Coimbatore, you will sit in the train for Coimbatore, no? Isn't it? If you want to travel to Goa, you will sit in the train meant for Goa. Right? So you will board the train which is going towards that particular direction. Isn't it? Now, the same is here. You invest money for the particular scheme which is appropriate with that particular maturity. Okay. So for example, if you want to invest money for up to 2 years, up to 1 year, these two are the ones we should be looking at. You should be looking at. Right. So just park this thought with you. We shall talk about it in detail when we learn about mutual funds. Now, what's the benefit of debt security? We've already learned about it. So it helps you diversify your portfolio. It gives you better risk exposure, lesser risk exposure. You can invest smaller amounts also. You can invest in SIPs also. Right? It's not that you only need to make a lump sum payment, but it's the best way to put your lump sum payment. Right? Let me give an example. Let's say you got bonus. Example. Okay. So let's say you got bonus, lump sum money. Let's say you got 2 lakh rupees, 5 lakh rupees, 10 lakh rupees, whatever. Now, if you put that money in equity markets and lump sum, the risk is very, very high. You should not put lump sum money in the equity markets, right? But debt is the asset class in which you can put lump sum money. Right? So while you can invest smaller amounts also, you can invest bigger lump sum amount as well in debt market. plus you get regular returns, right? Interest payment is made on a regular basis. And as we discussed, you can invest money for short-term, lump sum money for short-term, long-term, medium-term, all horizons, right? And you normally get the interest rate which is prevalent at that particular time, right? So whatever the interest rate is prevalent at that time, you get returns as per. So let's now learn deeper. So as we discussed, one component is up to 1 year is call money, also called as notice money, right? We have already discussed collateralized borrowing and lending operations. You have treasury bills of the government, right? You have certificate of deposits issued by banks. Okay, so these are the, plus you have the commercial papers issued by corporates, right? So let's learn about the call money. So call money is done over 1 year, 1 day period. Okay, so there are various institutions. Actually, these institutions will participate over CBL rules, right? So now there's a division. Call money is only for banks, only amongst banks, right? Then there are treasury bills. So as I mentioned, they could be for 90 days, 180 days, 182 days, 364 days, right? So these are issued by, this auction is conducted by RBI on behalf of Government of India, right? So this is an example. So this is a circular dated yesterday, as you could see. This is yesterday's circular by RBI, and they have announced that they would be doing an auction for 91 days, 182 days, 364 days treasury bills, right? And this auction will be done on 11th and 12th. 11th will be the auction, 12th will be the settlement date, right? So this is how. So from they will have both competitive and non-competitive bids. Right? Competitive bid means just like auction happens. So whosoever quotes the highest rates, they'll get government securities. Right? Non-competitive is for retail investors. So they don't need to submit competitive bids. They just need to apply, pay money, and they will get government securities. So again, the same thing. This is of June 10th. So this is of previous month. I mean, previous to previous month, right? So this is how it happened. Yeah. So this is for state development loans. Remember, I mentioned to you that when states require money, they would also ask RBI, support them get that money. So RBI is the authority which would be getting these auctions done, right? So this is for state development loans, right? Yeah. So this is again in detail about detailed circular about RBI's auction for treasury bills on 10th and 11th, sorry, 11th and on 11th of August. 12th is the settlement date. Okay. Now, as you could see in this circular, last month, RBI also announced that even the retail investors could participate in the auction for government securities, right? You can also participate in the auctions for long-term government securities directly, right? Let's say you don't want to go through mutual funds. You can participate directly with RBI, right? But obviously, when you participate through mutual funds, the liquidity would be higher there. And we shall discuss about more in detail when we learn about mutual funds. So they can open a bank account, a separate account with RBI, called RBI direct scheme. So they have to open an RBI retail. They have to open a retail direct gilt account, RDG account with RBI. Right? So RBI has this e-Kuber system where all banks are connected, right? That is where the all the clearing and all happens. So this participation in auction has to be done through that, right? So you can do it through a primary dealer or a bank. Okay. Let's learn about certificate of deposits. Who issues certificate of deposits quickly? Who issues certificate of deposits quickly? Please mention. Yeah, please. Who issues certificate of deposits? Banks. Yes, madam. Perfectly right. Correct. Right? So just remember, like fixed deposits you have, certificate of deposits is also like that. Right? FD, CDs, I mean, similar things. Okay. So CDs were introduced by RBI in 1989. And these are issued by scheduled commercial banks when they want to borrow money. The maturity is between a period of 3 months and 1 year. Okay. And these are tradable and negotiable. So one bank can, let's say a particular bank has lent money. So let's take an example. Let us say you have lent money to me, right? I required money. Now you have lent money to me. Okay. Now let's take an example that I have issued you certificate of deposit. I'm a bank, right? Now let's imagine that you need money now. So what you can do is the certificate of deposit that you have, you can give to someone else, right? So this is tradable and negotiable. Commercial papers are issued by corporates, by companies, right? Who can issue commercial papers? So they have to have working capital of minimum 5 years. By the way, working capital is the current assets minus current liabilities, right? So this can be issued in multiples of 25 lakhs, subject to 1 crore of maturity for a period of 3 months to 6 months, right? Again, this is transferring, right? So this keeps happening in the debt market. This kind of negotiation, trading keeps happening. Company debentures. So as we discussed, company debentures could be convertible or could be non-convertible, right? And the company decides to pay a certain amount when it's borrowing money. So let's take an example. Let us say company A issues debentures, and let's say these are non-convertible debentures, and it says that we will pay you interest at the rate of 8%, right? So you can lend money to the company. Now they would also get a credit rating from a credit rating agency, right? For example, it could be CRISIL. Just a minute. It could be CRISIL. It could be ICRA. It could be CARE, right? These are different credit rating agencies. So these credit rating agencies, just like, for example, let's say if you have a certain student, right, who wants admission in your particular college, it's quite possible that the college may want some credibility certificate from someone, maybe character certificate, right? So credit rating agency is the one who would be analyzing the issue and would give it rating, right? Now that rating could be a high rating, it could be low rating, right? So generally, if the rating is high, the interest rate will be lower, right? So if the rating is high, if the credit rating is high, the interest rate that people would be willing to lend money to that particular company would be low, right? But if let's say the interest rate, the credit rating is low, then people would want some incentive not to lend money to that particular company, right? Then in that case, the interest rate that this company will have to offer would have to be high, right? Just for example, I'm just sharing with you, in the northern side of the country, in the northern India, when they are giving house on rent to someone, when they give house on rent to someone, if someone if a South Indian family approaches them, no, let's Tamil family approaches them, then the landlord would be happy to charge a lesser rent also, because the perception is that people from Tamil Nadu, they are very good people. They would not fight with the landlord. They would not occupy the house for permanently. So the risk is lower. So landlords be willing to accept a lesser rent. But if the landlord suspects somebody that this person is a rogue person, this person could be a problematic person, then obviously the landlord would want a bigger rent, a higher rent to take care of that risk, right? The same is done by. We shall learn about credit rating later, right? So investors can subscribe to that scheme. Just for example, this is, although this is a little, this is of 2019, but just for example, India Bulls Consumer Finance had issued NCDs, non-convertible debentures, right? Interest rate was, so coupon rate is the interest rate. So here it was 10.6%, right? now, now look at it. So credit rating of double A is a decent one. It may not be the best one, but it's a decent one, right? So credit rating agencies are the ones which would, give a sort of assurance to the investor that we have checked, we have done the study about this issue. To our knowledge, it appears to be a reasonable issue, and we do not suspect, any default from the borrower, right? So that's how they rate it. Right? So this is an example of non-convertible debenture. Corporate fixed deposits, so companies will require fixed deposit, right? They may need money. PSUs and BFCs, they will require money, and they will also offer fixed rate of interest, right? It may vary from a few months to few years, right? So investors can opt for different kinds of schemes. It could be a scheme which is paying interest every month or every quarter or every year. Similarly, a particular scheme may be the one which only offers money at the time of end of the scheme, cumulative interest, right? In the example that we saw, for example, right? So madam gave the answer that they will get 12,800 rupees. So that's perfectly correct answer for a cumulative scheme. So if someone had lent money for 3 years in a cumulative scheme, right, then interest of 700 multiplied by 3, 2,100, right, plus 10,000 rupees of principal, that would paid in lump sum at the end of 3 years. That's a cumulative scheme. But somebody says, no, I don't want a cumulative option. I would want a monthly option or a quarterly option or a yearly option. Then they may offer that as well. So just for example, so these could be examples of certain fixed deposit schemes, right? And as you could see, they carry credit rating, right? So AAA credit rating is absolute security. That's the highest rating, right? So HDFC Limited, Mahindra Finance, Bajaj Finance, LIC Housing Finance, Shriram Transport. Shriram Transport also carries very good rating. Right? So this is an example now, as you could see. Let's see yield which you are going to be getting, right? Over 1 year period, for 1 year, 2 years, 3 years, 4 years, whatever. Right? So they offer additional 0.25% for senior citizens. Right? That's just an example. So this is how the rating looks like. So AAA rating, AA rating, next level is AA, next level is now they could also have plus minus along with it. See, just like the grade which you offer to your students, no? Right? So the best student may get, let's say, A1 plus, sorry, A plus, right? The next one may get A. Then the next one, next level could be B plus. So this way. So this is how credit rating looks like. Now this is for long period, more than 1 year. So any scheme where you have lent money for more than 1 year, right, except the government scheme, should have credit rating. Now these are the credit rating agencies. You have CRISIL, you have ICRA, you have CARE, you have Brickworks, you have India Ratings, you have ONICRA, you have SMERA. Right? And this is the highest rating. So as you go down, the risk increases. Right? So let's say one scheme which is AA rated and the other one which is, let's say, single A rated. Let's say scheme A is rated as AA and scheme B is rated as A. Which scheme will carry more interest? Which scheme should be carrying higher coupon rate? Scheme A or scheme B? Yes, ma'am. Yeah, yes, please. Yes. Scheme B will carry higher interest rate. Correct. Why? Because the risk is higher. Right? So scheme A would have lower risk. Scheme B will have higher risk. Right? If let's say scheme B has higher risk, the interest that scheme will have to pay will be higher. Else I will not lend my money, no? Right? I would want some compensation for the risk that I am taking. Just like, what these loan companies do is, if let's say a doctor is taking a loan, right, or a professor is taking a loan, they may offer a lesser interest rate to the doctor or a professor. Why? Because these people have got a lot of respect in the society. I mean, it's one of the noblest profession that you have. You guys are gurus, right? So obviously, that's a very, very noble profession. So the chances of you defaulting on your commitment is very low, right? But let's say if somebody is a businessman and that too, let's say a builder, right? Now, as we know, the reputation, by broadly speaking, it's not that 100% builders will be bad, but broadly speaking, the reputation of builders may not be good, right? So if somebody is a builder and wants a loan, probably the institution would be charging a higher interest rate to them. Why? Because the risk to default is higher, right? But let's say if you are borrowing money for, if you are lending money for less than 1 year, right? Then these are the rating scales which you should look at. So whenever there is a numeric associated with it, no, 1, 2, 3, whatever, then you can understand that this is what below 1 year period. For 1 year or below 1 year period, right? So they will have a number associated. So A1 plus, then A1, then A2 plus. So they may put plus sign also, right? If the security is even far higher. So between A2 and A2 plus is superior, right? So non-convertible debentures again, convertible debentures could be converted to equity shares, right? So the borrower pays a fixed pre-decided rate of interest, right? Interest rate depends upon the credit rating, as we discussed. Higher the rating, lower the interest rate, but lower the rating, higher the interest rate, right? Again, it could be callable or puttable. What is callable? So let's take an example that Muthoot Finance, just for the sake of example, Muthoot Finance Limited, they have issued non-convertible debentures, right? They are paying, let's say, 11% rate of interest. It's for a period of 3 years, right? But it's a callable bond, right? It's a callable bond means that Muthoot Finance can foreclose the scheme before 3 years, right? It can decide to return the principal along with interests applicable before a period of 3 years, right? That is callable by the borrower, right? Puttable means it can be foreclosed by the lender. If you have lent money to Muthoot Finance and suppose the scheme says that it is puttable, it means that you can decide to foreclose the scheme before its due period. You can tell them, sorry, I don't want to park my money with you. Give me my money back, right? That's puttable. Okay. So callable and puttable. Now, how can it happen? Say it's quite possible that they have issued the loans. They have issued this scheme at 11%, but now the interest rate in the market goes down, right? Now they can get money at 9% also. So why should they pay interest to you at 11%, right? So if it's a callable bond, they will say we are closing the scheme now, right? Similarly, if it is a puttable bond, right? Puttable debenture, and you see that you can get lend money at the rate of 12% somewhere. You have lent money to them at the rate of 11%. Why would you continue with that particular debenture? You will say, give me my money back. I will now lend it at 12%, right? So that is how callable and puttable works. Yeah. All right. So debentures, they offer a decent return. See, although it is claimed that they are tradable in the market NCDs, but actually they are not much tradable, right? So theoretically they have liquidity, but from a practical perspective, they don't have liquidity, right? So just bear in mind that the liquidity here could be lower. You may not be able to foreclose the scheme if it is not a puttable scheme. And more often than not, right, the scheme may not be puttable because the person who is asking for money will not make it puttable. He may make it callable. The company may make it callable. And they can foreclose the scheme, but generally they don't make it puttable. So There's no upfront TDS deduction here. So it can help you diversify your portfolio, right? So for example, you say that the bank is giving me only 5% rate of interest. Well, if I take slight risk, I can get maybe 7%, 8% rate of interest, right? And you decide to allocate a certain portion of your portfolio to that scheme. Okay. So just for example, this is last year, 2020, right? The scheme is closed. So just for example, AA rated Muthoot Finance, it offered 7.75% rate of interest. Like I was telling you, right? So 38-month scheme, the coupon rate was 7.15% monthly. But if you wanted annually, it was 7.4%, right? If you wanted a cumulative, if you wanted a 5-year option, right? Then 7.5% and 7.75%. So generally, what they advertise, would be the one which would be, the option which is either annual one or cumulative one. Right? So please read it thoroughly before taking a decision. Okay? So AA rated means it's adequate safety. Another example, so Muthoot Finance issue rated by CRISIL, right? So this particular issue rated by Muthoot Finance, sorry, CRISIL, right? So they have confirmed AA rating, right? So AA positive is the rating. AA positive is the rating which they are giving. Right? So this is how, whenever you invest money in any debenture or any corporate bond scheme, please do refer to the rating, because credit risk is there in a bond issued by a non-government organization, right? When you are lending to the government, there is no credit risk. But when you are lending the money to a non-government organization, right, there is credit risk. So please refer to the credit rating. Let's now talk about bonds, and that requires a lot of discussion. Okay, so what kind of bonds do we have? So we have zero coupon bonds, right? Now, as the name suggests, in a zero coupon bond, so normally in a bond, let's say this is a Government of India bond, 2040. Example, 2040 bond, which means it will get matured in 2040. It will mature in 2040, right? And against it, it will be mentioned the rate of coupon. So it will mention, let's say 6.15%, for example, right? Which means the interest is payable at the rate of 6.15%, right? Now, in a government bond, the interest is payable half yearly, every 6 months, right? And generally, the face value of the bond is 10,000 rupees. Which means if you want to invest 1 lakh rupees, you will have to buy 10 bonds. Right? So, for example, in a normal, let's say, government bond, the face value is 10,000 face value is 10,000 rupees, which means that every year, if the rate of interest is 6.15, how much interest will you get per bond? If the coupon rate is 6.15%, how much interest will you get per bond every 6 months? How much money will you get every 6 months? Yeah, Yeah. What's the kind of yes, absolutely right. Absolutely right. Well said. Yes, 650. But remember, 615 is the yearly rate, right? You are going to get interest on a half yearly basis, no? So practically it will be 307.50. 307 rupees 50 paisa, right? Because you're gonna get every 6 months. So let's say if the interest rate is 7%, then you will get 350 rupees every 6 months. Right? So this is all. Now, normally this this bond, when you are buying it at the time of issuance, okay, when this bond gets issued, let's say you participate in auction, it will be available to you at 10,000 rupees, right? So it will be available to you at 10,000 rupees, and in 2040 you will be able to get 10,000 rupees back, right? And you will keep getting interest payment on a regular basis. Correct? This is what it looks like normally, right? More often than not, all bonds are like this. But sometimes you may also see zero coupon bond. So zero coupon bond, as the name says, does not have any coupon rate, right? So there is no interest payable, no interest payable. So if it is maturing in 2050, you will get 10,000 rupees per bond after 2050. Now you will say, then why will I lend money? If no interest is being paid, then am I a fool who will lend money? That is why they are available at a discount, right? So this bond worth 3,000 rupees may be available for this bond worth 10,000 rupees, right? May be available for 4,000 rupees, right? So the difference between 4,000 and 10,000 is practically what your interest is, right? So that is why it is called as zero coupon bond, because there are no coupon rates. Okay, so it is issued at a discount to the, but redeemed at the face value. Corporate bonds, so again the same thing. They are issued by PSU or reputed private companies. So again the same thing is that it's important for you to check out the issue price. Sorry, the rating. I beg your pardon. It's important for you to check out the rating. What's the rating, right? Because credit risk could be there in a non-government issued bond. Okay, government bonds, no credit risk, right? So obviously there is no need for any rating there, right? So these could be issued by central government or state government or municipal corporations. Like for example, I'm sure you will have Chennai Municipal Corporation in Chennai, right? In Mumbai, we have Brun Mumbai Municipal Corporation, BMC, right? So they also, all governments, they do not carry any credit risk, right? Okay. Now, again, as we discussed, treasury bills could be up to 1 year and bonds could be beyond 1 year, right? Issued by government. So this is how it looks like. It will say 8.33 GOI bond 2036, which means it's going to be maturing in 36, sorry, right? And the coupon rate, the interest payment you're going to get on the face value is going to be at the rate of 8.33%, right? Now, normally these government bonds could be up to 3 years. Up to 30 years, I beg your pardon. I think I said 3 years, up to 30 years. All right. So, up to 1 year could be in treasury bills, and for long term, it is in the form of government securities or government bonds or what is called as gilt security, gilt edge security, right? Now, normally you have to, this will be available in your demat account. Nowadays, demat has become compulsory. Earlier, it was optional. Now it is compulsory, right? So it is not in physical form. Sorry for this. It necessarily has to be in dematerialized form. This, I missed out correcting it. So it's dematerialized. Okay. Okay. Now, very important thing. How is the government security or how is any corporate bond price? How does it work out, right? So I will spend some time on this. Maybe we may get some 5-7 minutes late today because this is a very important topic. And believe you me, if you have understood this concept, no, you have almost understood more than 50 or 60% of debt market, right? So let me open an Excel sheet and explain. Before that, say these government securities or corporate bonds, right? Whether it is corporate bonds or whether it is government securities are tradable, right? So corporate bonds or government of India bonds, they are tradable, right? Okay, there was a question that somebody had asked, what's the difference between commercial papers and bonds? So bonds are for long term, beyond 1 year. Commercial papers are for up to 1 year, right? That's a very simple difference which is there. Certificate of deposits are issued by bank up to 1 year. Commercial papers are issued by companies up to 1 year period. Bonds are for a period more than 1 year, right? So, madam, since you had sent the message directly, I'm not taking your name. I hope you would have got the answer, right? Okay, bonds and debentures. So, debentures are issued by non-governments. Bonds could be issued by both governments and non-governments, right? Debentures are normally for a period of 3 to 5 years, right? Could be convertible, could be non-convertible. Bonds could be for a longer term, right? But practically speaking, debenture is also a promise which is being made. So to that extent, that is also a bond, so to say. It's a promise which is being made by the corporate, right? But what we normally call as corporate bond is for a longer term, right? Otherwise, in terms of plus bonds are tradable. Unfortunately, non-convertible debentures, are not tradable to that extent. Theoretically, it is said that they are, but actually they are not, right? So, bond is a promise. Anyone who is borrowing has a promise, is making a promise. But for all practical purposes, normally what we call as corporate bonds or PSU bonds are for a longer term. Normally, they could be for a short period also, but normally they are for more than 5 years. NCDs are normally not beyond 5 years. All right, let's now understand how does it work. So whether it is corporate bond, whether it is government bond, they are tradable, right? Tradable in the sense that a person A or bank A can sell it to bank B, right? Let's say a particular bank has bonds of Government of India. So a particular bank A owns Government of India bonds, has lent money in Government of India bonds, let's say 8.5%, right? And they are maturing in 2038, for example, right? Which means 17 years are still left, right? Now, let's say bank B has money available with them. They are willing to invest money, and bank A requires money, right? Bank A requires money. Bank B is willing to invest money. Then bank A will in the market, bank A is offering these securities, right? Bank B is willing to buy these securities. They are willing to invest money in these securities, right? Now let us say, the face value of the bond is 10,000 rupees. Okay. Now these bonds carry coupon rate of 8.5%, right? Now the interest rate has gone down, right? Suppose this was a 30-year bond and this was issued in 2008, right? It was issued in 2008, right? 30 years back. It was a 30-year bond, right? Today is 2021. 17 years are still left. This was issued 13 years back, right? Now, whatever new bonds are coming, because the interest rate has gone down, now the new bonds are coming at the rate of 5.2%, for example. So the prevalent interest rate is 5.2%. This bond gives interest at the rate of 8.5%. So now you tell me, how much will this bank charge for this bond? How much will this bond, if bank B wants to buy this bond, will they be able to buy it for 10,000 rupees or will they have to pay a higher price for that? How much would bank A sell this bond for? Yeah, please tell me. Higher price. Yes, Priya madam. Why? Why? Because the prevalent interest rates are low, right? Yeah. So, yes, Poonamallee madam, the current interest rate is very low. And obviously, this bond rate is higher, right? So, this is the premise I wanted to leave. I wanted to share with you. Let us now actually look at how does it work out. So, one thing I missed out. Just a minute, I'll connect again and share that also. Just a minute. Yeah, so I'm connecting again. See, one thing is important for us to understand. Okay. See, if we are not able to complete it today, if let's say there is some clarity required, please do not worry. We shall discuss it on Monday, because this does require some, detailed clarification, right? I don't want to rush with it because this concept is very, very important, right? All right. So just understand one thing, that if we are investing some money today, right, 2021, and this, if we are investing money, we are not lending money right now, we are investing money. If we are investing money today, right, in any investment, it could be equity, it could be any other investment. And let's say we are investing it for a period of 5 years, right? 10 years, let's say 2031, right? Then obviously, if we are investing in lump sum, let's say equity should not be invested in lump sum, just a clarification. Let's say wherever we are putting money, assume we are doing it, you are buying a property, let's say, right? So you're buying, let's say, property for 10 lakh rupees. Your money will grow, right? This is called as compounding, right? So when you move from 2021 to 2031, it is called as compounding. So 2021 is your present value. Present value is the money which you have invested today, today's price, right? Today the value of that money is 10 lakh, right? And what it would accumulate to in 2031 is called as the future value. Correct? Now just imagine a situation that this amount becomes, just for the sake of example, that this amount becomes, let us say, 25 lakhs. Just for example, right? Now, let us say somebody asks you that 10 years from now, a certain investment becomes 25 lakh rupees. Right? In 2031, you are going to get 25,000 rupees. 25 lakh rupees, I beg your pardon. If you got return at the rate of 10%, right? How much money had you invested? Right? Which means now you are being asked to compute present value from a certain future value. The future value is 25 lakhs. You have to compute the present value, right? So you are moving from past to, you are being asked to move backwards, right? From 2031 to 2021. Okay. This is called as discounting. Right? So compounding is when you move forward from present to future, right? But suppose you are computing how much would you have invested, right? Then that is called as discounting. Okay, so just keep this thought with you. What we shall do is we will discuss more about it, on Monday, when we learn about the anti-money laundering. We will discuss that later on. First thing, we will discuss this thing because that's going to be important for you to understand. Okay, but right now, just understand this thing, that government securities are issued at face value. They carry no default risk. They have ample liquidity. They are freely tradable, right? There are a lot of buyers and sellers who are available in the secondary market, right? Interest payment is on a half-yearly basis, as we discussed, on the face value. No taxes deducted at source, right? They have to be held in demat form, okay? And the rate of tenor, which is the coupon rate, is fixed, right? So depending upon what price do you buy it at, you can work out the yield to maturity, right? We will discuss the yield to maturity part later. Okay. So they are redeemable at the time of maturity at the face value, right? All right. Maturity ranges between 1 year to 30. So again, madam, your question, the difference between NCD and bond. Bonds are normally for a longer term. Corporate bonds are also for a longer term, right? But as you could say, bonds could be for a shorter period as well, including GOI bond. Below 1 year period, they're called as treasury bonds. So just an example. This is an example of a PSU bond, IR, Indian Railway Finance Corporation. As you could see, 7.5% is the interest rate. Now, when we discuss on Monday, we shall learn that how this price matters, right? How does the yield to maturity gets calculated? How does it actually work, right? So how does the price of a particular bond get computed? This we shall learn on Monday. Okay. Another type of bond is that suppose you have sold a land, property you have sold. Now you will be having capital gains, right? Now you can save money on those capital gains by putting money elsewhere. For example, you can put it in bonds. I am sure many of you would have property, would have sold property, and you would have known that you can save taxes through these long-term capital gain bonds, right? Where can you put this money? The bonds are issued by National Highway Authority of India, Rural Electrification Corporation, Power Finance Corporation, and Indian Railway Finance Corporation, right? So this was the example. Previous slide, I had shown you the picture of IRFC bond, which are available in the secondary market, right? Because they are tradable. So that's a secondary market price which is available. They are AAA rated bonds, so complete security, right? Investment could be done up to 50 lakh rupees, starting from 10,000. Term is of 5 years. Interest rate today is 5%. Right? So whatever money you invest up to 50 lakhs, it can help you save capital gains. Investment period is up to 5 years. Okay? There is no TDS on this. That does not mean it is tax free. It's just that tax on deduction at source is not. Right? Sovereign gold bonds, as we've discussed, it's better idea to invest in sovereign gold bonds, right? Now the beauty here is that you also get interest at the rate of 2.5%, right? So not many people know about it. When you invest in a sovereign gold bond scheme, you get interest at the rate of 2.5% rupees, 2.5% every year, right? The bonds are available to you in your demat account. It's an 8-year scheme, right? It's an 8-year scheme, and after 8 years, there are no capital gains. No capital gain. Tax free, right? So if you want to invest in gold, that's a very good thing. In fact, just to share with you, my wife also invested money last year in this. So she was also keen to buy jewelry. I said, "You are wife of a financial planner. How can you do that?" So I made her put money in sovereign gold bond scheme. Right? All right. And now there is, if you Google it, you will find that from August 9th rather, from 9th August, that is Monday, a new sovereign gold bond scheme is being issued by RBI, right? The gold price is 4740 per gram, right? 4740 per gram. And if you pay online, if you pay for it online through your bank, whatever, you get 5% discount, right? So then this will cost you, practically speaking, what, 4716 per gram, right? And obviously the after 8 years, whatever the price of gold is, right, you'd be able to sell it off. RBI will buy it from you. In case you need money, you can also give it to RBI after 5 years also, right? But don't, you can sell it before 5 years also, but then it will become taxable. Just keep in mind. Okay. Tenure is 8 years. Upon redemption, you get price equivalent to the gold, right? No capital gains if held for 8 years, right? So if you have held it for 8 years, then there are no capital gains. If you sell early, the capital gains will be there, right? So if you sell before 8 years, capital gains will be there. Okay. So this is what I was talking about. From 9th August, day after tomorrow, those of you who want to invest in gold, so it's definitely a good scheme. It's run by the government. You get 2.5% interest also. So just like your savings bank account. So practically speaking, it's like you put money in the savings bank account, right? But the value of that money will keep appreciating in line with the prices of gold. It's a fantastic idea, right? But my suggestion is, do not put beyond 10% of your portfolio in gold. At the most, restrict the allocation to gold to only 10%, not more, right? Because as an asset class, gold has been very volatile, and historically, it's not given more than 12% returns, right? Whereas equity has given far better. So just an example, this is of a previous period, that This is what it is. At that time, 4639 was the price. Now it is 4740, right? You get 2.5%. You can also use it as a collateral for loan. So banks will be happy, in case you want to use it as a collateral. No capital gains if you hold it for 8 years, right? And it is indeed a good scheme. I'm sure it would be written that you get 5% discount if you pay online. Yeah. See, 50 per gram if you pay online, you get discount. Okay, so this we have already discussed, credit rating. Risks in I'll take just 5-7 more minutes. Risks in investments, as we've discussed again and again, we need to understand it. In the debt market, the interest pertain to credit risk, interest rate risk, right? So what is interest rate risk? Interest rate, we'll talk in detail day after tomorrow, but just understand one thing. In the prices of bonds, right? Bond prices, like I gave you this example, when the interest rates go down, when the interest rate go down, right? The price of bond will go up. Just I gave you the example, because the bond which was paying interest at the rate of 8.5%, now the new bond is paying only 5.3%. So the price of the bond has gone up, right? And if the price of the bond has gone up, right? Price of the bond has gone up, which means the yield has come down, right? So there is inverse relationship between price of a bond and its yield. Yield is how much do you actually earn over a period if you hold that. It's also called as yield to maturity, right? So very simply speaking, if the interest rates have gone up, if the interest rates have gone up, right, the price of bond will go down and the yield, right, if the price goes down, the yield will go up, right? So yield and interest rate move simultaneously, whereas yield and price behave inversely. Okay, just to repeat it again, if the interest rate goes down, the yield of a particular bond will come down as well. Why? Because the price will go up, which means if the price of a bond goes up, the yield will come down. If this will become clear with the next slide, just a minute. So you could see here, when interest rate goes up, the bond prices go down, right? If interest goes up, price comes down. If interest goes down, price will go up, right? If interest goes up, price will come down. If interest comes down, price will go up. Just keep in mind, right? In IT, you have no IP address. Just keep IP in mind. IP, interest price, right? They work in an inverse manner. Interest goes down, price goes up. Interest goes up, price goes down, right? Interest price. Just bear in mind. Interest and yield will go simultaneously. Okay? Interest goes up, price comes down. Interest comes down, price goes up. Interest goes up, price comes down. Right? Interest and yield will go simultaneously. YIELD, YI. So remember YI. So yield and interest are simultaneous, right? IP is inverse. I hope it is clear. Please let me know if it is not clear. Is it clear? Right? Just to repeat, interest and price they are like seesaw, right? Interest goes up, price comes down. Interest goes down, price goes up, right? So when interest rate go down, right, the prices of existing bonds go up. Why? Because more and more people will want to buy that bond, because that would have been issued at a higher, the coupon rate will be higher, right? So IP, remember, interest and yield, they go simultaneously. Why? Because there is an inverse relationship between price and yield also, right? If price goes up, yield comes down. If price goes down, yields go up, right? I'm repeating it again because some of you may be getting bored, but the reason is I want to make it very clear to you why is it so, right? Again, at the cost of repetition. See, what we saw was 2038 bonds, right? The interest rate was offered, coupon rate was 8.5%, right? Although the face value of the bond was 10,000 rupees, the bond would now be sold for a higher price. Why? Because the interest rates have moved up, right? So the interest rates, now the interest rates have gone down. I beg your pardon. Now the interest rates have gone down. Okay. So because now the interest rates have gone down, now the new bonds are offering lesser interest rates. So the prices of bond will go up. The ones which were issued earlier, their prices will go up. They will be in demand. Okay. So just keep this in mind. Maybe you can take a screenshot of this particular thing if it is possible. It will help you remember. Plus, you would have done that. Okay. Right. So this is what we learned about today. The need for debt markets, the interest bond relationship. And we shall learn more about it. So we have 2 more sessions on equity. We have sufficient time with us. And I'm very confident that, Monday we shall also take doubts. So whatever doubts you may have, for all these sessions, please you may write it, and I would be very happy to answer all those doubts. I'm sharing the, okay, today's quiz is easy. It's very easy. If you have attended today's session regularly, you will find that you would definitely be able to answer this. And you will also get the marks as I was mentioning. So you would not need to submit it again. How to get that scheme, madam? You can go to your bank, or if you want to buy online, Stock Holding Corporation of India, right? I bought this scheme for my wife online itself. So just log into Stock Holding Corporation of India. I think it is shcil.org or something like that. I don't remember right now. Just Google it, please. And you can, you will have to scan your PAN card, all those things, give your account number, date of birth, blah, 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 blah. Choose the nominee and then pay the money online, and it will hit your demat account after, few days. That's the easiest way. You also get discounts. So you'll be able to buy it at a lesser rate. No need to involve any agent, blah, blah, blah. You can do it directly. Else, if you have, online banking, mostly banks just log into your net banking. So there also you will be able to see, apply for this thing. That's an easiest way. You can straight away apply through online banking, and it will be a good thing. Good thing is, you get 2.5% interest also. Saving banks interest also is 2.5%. So it's like you're getting the same interest rate virtually. Okay, just to share with you my contact details, in case you want to be in touch, you're most welcome. Hope you found today's session to be useful, because I was trying to explain it at a slow pace, because debt is generally considered to be a very complicated subject. Uh, I hope you found it useful. In case there are any questions, I'll be happy to answer.
Yes, sir.
Any questions, please?
Sir, I think there are no more questions.
Sorry. Madam, was I able to explain the difference between NCDs and bonds? Did that question get answered? Can you let me know? Or is there any doubt? Please do let me know if there's any doubt. All right, madam. It seems there are no questions.
Okay, sir. Thank you, sir. It was such an engaging and lively session. I would like to thank and place on my record my sincere appreciation to you, sir, for deliberating this session with insightful analysis and exemplary knowledge. Now, I would like to invite our professor, Dr. R. Kamaraj, Assistant Professor and Head, Department of Commerce, Computer Application, to propose the vote of thanks. Sir, over to you.
Thank you, madam. I deem it a great honor to propose the vote of thanks to all who have helped us in making this webinar such a resounding success. First of all, I'd like to thank the proposal vote of thanks our correspondent, Mr. Venkatesh Raja, for his moral support and guidance. I would like to propose two handful vote of thanks to our chief guest, Mr. Ravindra Singh Chawla, founder and managing partner, RSC Skill Building and Consulting Solution, for gracing today's webinar. Thank you, sir, for your very interesting and thoughtful, provoking address. I would like to express our profound gratitude to our principal, Dr. Maladi Selvakumar, for your presence in this webinar. I would also like to thank our director, Dr. Sai Satyavadi, ma'am, for his support and guidance. I would like to thank the program coordinator, Dr. S. Ganapati, for all the day events for making this webinar a great success. I would like to express thanks to our staff members and technical who have made this webinar a grand success. And I would like to thank all participants from various institutions. Thank you so much for your cooperation. Once again, I thank all your cordial cooperation in future. Thank you, ma'am. Thank you, sir.
Thank you so much. Thank you.
Thank you, sir.
Have a great weekend, all of you. Please enjoy yourself. Thank you.
Thank you. Sir, I think with that we have come to the end of the each and every one of you who participated in this session today for your time and cooperation. And participants, please kindly answer the quiz before 5 p.m. And as tomorrow is a Sunday, we do not have a session tomorrow, and we will all meet on Monday. Until then, stay safe and have a great evening. Thank you, sir.
Thank you. Thank you. Vanakkam. Namaskar. Bye.
Vanakkam, sir.